Intro. Welcome to this video on how a recession could result from the 2023 banking crisis. The health of the economy as a whole depends on the financial system stability. In this video, we'll look at how a banking crisis might stop the economy from operating normally and start a recession. Part 1. The role of the banking system. The banking industry is essential to the economy. It makes it easier for money to move from savers to borrowers, giving people, companies, and governments access to a vital supply of credit. Additionally, banks are essential to the payment system because they guarantee the quick and secure processing of transactions. Additionally, banks control a substantial percentage of the money supply, and the success of the economy as a whole can be greatly impacted by the lending and investment decisions made by these institutions. Part 2. The causes of banking crises. When many banks experience financial difficulty or fail, a banking crisis develops. Several factors, like the bursting of a real estate bubble, a stock market collapse, or a decline in the economy, might contribute to a banking crisis. Inadequate supervision, inadequate legislation, and poor risk management techniques can also make the issue worse. Like, for example, 3 small to mid-size US banks failed over the course of 5 days in March 2023, prompting a dramatic decrease in bank stock values globally and a prompt response from regulators to avert potential worldwide contagion. Silicon Valley Bank, Silvergate, Signature Bank. The failure of Silicon Valley Bank to foresee the consequences of locking depositor funds into relatively low interest rate securities rather than risky investments or fraud was the real reason of the bank's bankruptcy. The demise of Silvergate Bank ultimately resulted from significant losses on asset sales at the end of the previous year when the bank sold securities at fire sale prices to stay afloat during a bank run. On March 12, 2023, federal regulators closed down Signature Bank. The bank's demise was caused by regulatory worries about depositors withdrawing substantial sums of money following Silicon Valley Bank's SVB failure and the worry of further contagion. Part 3. The economic impact of a banking crisis. A banking crisis can cause a significant disruption in the economy, which can have the following effects. Credit is less readily available because banks become cautious and stop lending to people and businesses during a banking crisis. Credit becomes less readily available as a result, which might make it challenging for individuals and enterprises to get the money they want to make investments and expand. A recession results from a slowdown in economic activity. Loss of confidence. A banking crisis may cause people to lose faith in both the banking industry and the economy as a whole. Banks may experience a run as a result of depositors withdrawing their money out of concern for their safety. This might weaken banks even more and lead to their failure, creating a vicious cycle that could make the crisis worse. Asset price deflation. During a banking crisis, the value of assets like equities and real estate may drop. As a result, people and businesses may be less likely to invest and spend money, which could slow down the economy and cause a recession. Fiscal costs. To bail out failing banks and support the banking system, governments may be required to pay a sizable sum of money. This would result in larger levels of public debt and budget deficits, which might undermine economic confidence and trigger a recession. Case study: the 2008 financial crisis, Part 4. The financial crisis of 2008 serves as an illustration of how a banking crisis might trigger a catastrophic recession. The collapse of the subprime mortgage market, which resulted in substantial losses for banks and financial institutions, served as the catalyst for the crisis. Due to the broad credit crunch that resulted from this, banks started to be reluctant to lend money to one another as well as to people and companies. As a result of the crisis, the value of assets like stocks and real estate fell precipitously, and many jobs were lost. Although governments had to intervene with significant bailouts to stop the banking system from completely collapsing, the crisis still caused a severe recession, with many economies experiencing sharp declines. Conclusion and prevention in Part 5. In conclusion, a banking crisis can seriously impair the economy's and financial system's regular operation, causing a recession. As a result, it is crucial to take action to stop and lessen financial crises, such as through strict regulation, efficient oversight, and reliable risk management procedures. We may contribute to the stability of the economy as a whole by guaranteeing the stability of the banking system. Let's hope we can draw lessons from prior crises and implement strategies to stop them from happening again. Many thanks.